This is our first video for Chapter 7. We will be looking at the allowance method using the income statement approach. Jedi Company uses the allowance method to account for uncollectible accounts receivable. Bad debt expense is established as a percentage of credit sales. For year 1, net credit sales totaled $5,340,000, and the estimated bad debt percentage is 1%. The allowance for uncollectible accounts has a credit balance of $41,000 at the beginning of the year 1 and $39,800 after adjusting entries at the end of year 1. And we are required to determine the amount of bad debt expense for year 1 and accounts receivable written off during year 1. So let's go ahead and figure out what bad debt expense for year 1 is. Before we calculate our bad debt expense, I want to briefly point out the two types of approaches you can have for the allowance method. First is the income statement approach, is what we're doing in this video. It only includes income statement accounts when calculating bad debt. So what we're using here is net sales, and then we're given a bad debt percentage based off of sales of how much we expect to be uncollectible, which makes sense because sales and expenses are on the income statement. The balance sheet approach only includes balance sheet accounts in the calculation of bad debts. So we'll use accounts receivable and allowance for uncollectible accounts, balance sheet accounts, when using this approach in a later video. So with that being said, let's go ahead and calculate bad debt expense for year 1. So we need to find our net sales, $5,340,000. We'll plug that in. And then the problem also tells us that the estimated bad debt percentage is 1% of net sales. So we'll multiply this by 1%, 0.01. And doing that, we get $53,400 as our bad debt expense for year 1. Now that we have our bad debt expense, we can go ahead and make the journal entry. It's going to be a debit to bad debt expense for $53,400, and we will credit allowance for uncollectible accounts for the same amount, $53,400. So this is what we're estimating based off our net sales, how much we won't be able to collect. The debit to bad debt expense is just like a normal expense account. It increases with the debit. Allowance for uncollectible accounts is a contra asset account against the accounts receivable account, so it will increase with a credit. Now let's answer the second part of the problem. The amount of accounts receivable written off during year 1. How much is it going to be? And then we'll make the journal entry. So we can look into our problem again for some information. It tells us the allowance for uncollectible accounts had a credit balance of $41,000 at the beginning of year 1. So let's fill that in. Next, it tells us it had $39,800 after adjusting entries at the end of year 1. So we can fill that in as well. And also, in the last slide, we just credited the allowance for uncollectible accounts for $53,400 when we calculated bad debt expense. So what we need to figure out how much of accounts receivable was written off is we need to figure out what the debit is for allowance for uncollectible accounts. That gets us to this in number. So what we need to do is add these two numbers, entries we made during the year, and then subtract our end amount, which will tell us what the debit was that decreased the allowance for uncollectible accounts. So if you add $41,000 plus $53,400, and then you subtract $39,800, we'll get $54,800. So this is the journal entry we'll make, and this is what the amount of accounts receivable written off during year 1 was. So as a journal entry, we now debit allowance for uncollectible accounts. $54,800. And then we credit accounts receivable because these are now accounts that have been totally written off according to the problem. We know we're not going to be able to collect them, so we're just going to write them off accounts receivable. So it's a credit for the same amount, $54,800. And with that, that's how you solve one of these problems with the income statement approach for the allowance method.